You are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. John, here we are. We're having another special guest today because of the Wealth Summit coming up, and we're excited about this person being there, going to be speaking for us and sharing not only good information, but funny stories with us as well.
I'm looking forward to it. You know, if you ever, heaven forbid, get the brown envelope from the IRS that says you're getting audited, you end up sitting across the table from the IRS. You want somebody like Jack Cohen on your side of the table.
Oh my goodness!
Jack
yes.
Cohen has a 33-year career with the IRS. He won the David Bernard Award in 2006, which is like Employee of the Year in his division. We like to say that Jack has turned back from the dark side and now works for the light side. He's retired from the IRS. He works as a private CPA, has a lot of different clients with the firm he is with, and he represents them in front of the IRS. Very important there. Thank you for joining us today, Jack.
Thanks for having me, and you are correct. I took the black hat off and put the white hat on. And I've seen the light, so I can tell you.
All right. That's wonderful. Well, we're sure looking forward to you coming and speaking at the Wealth Summit. For those of you listening, be sure to get your tickets. If you're in the area, wealthsummit.net, or you can call our office, 702-660-7000. The Wealth Summit is coming up this coming weekend, so if that's too late for you to be able to make it, contact our office to get the recording of the event. We'll make sure that you can get that. This will be our last summit because we're planning something different in 2019.
We've got something real excited planning, don't we, John?
That's right.
Well, if you are local or you can hop on a plane and get here by this weekend, this Friday for the Wealth Summit, you do not want to miss Jack's presentation. I'm personally going to be talking about the costs that are squeezing your ability to build sustainable wealth right out of your life. And Jack, you're going to be talking about something called SALT, state and local income taxes, and how the new federal tax law is putting the squeeze on those.
Absolutely. Well, there's this new 2018 tax law. There's a lot of parts to this, and some of the parts are still ununderstandable by many people. The IRS, in some cases, hasn't actually provided its guidance. But there are going to be, as I've said once before, there's some good parts to this new tax law, and there's some parts that some people are not going to be very happy about, and one of them has to do with state and local taxes. Absolutely. So that will be a topic.
So could you tell us a little bit more about how that works in the new tax law? What's going on behind the scenes here?
Okay. So in the past, one of the deductions that taxpayers have been allowed, as long as I've been involved in federal taxes, has been a deduction for state, local taxes, and real estate taxes. And so when you say you live in California and you have to pay California state income tax, or you have to pay real estate taxes on your property, that deduction has always been allowed as an itemized deduction. And in some cases, depending upon where you live, it could be pretty significant. I came from New Jersey, and I can tell you real estate taxes were very high. And so what happens effectively, though, when you think about it, when people took these deductions on their federal tax return and then consequently paid less federal tax, or maybe you got a greater refund, effectively the federal government was subsidizing you for this deduction. Part of this new 2018 tax law, one of the big changes is they put a limitation on how much you can claim for this deduction. And the limitation's really low. It's $10,000.
Oh, that's going to hurt people in states like California, isn't it?
Absolutely. Any place that has a high income tax or high property tax, like California, I'm thinking New Jersey, New York, Illinois, generally bigger metropolitan areas that have, or even Pennsylvania that has a city of Philadelphia local tax. Again, any place that has high income taxes, and we're talking personal taxes, not business taxes. That's something totally different. But if you're paying high personal income taxes and real estate taxes in 2018, when you go to prepare those 18 returns, that deduction is going to be capped at $10,000. And for many people, especially like you use California as an example, I mean, to pay California 40 or 50 grand a year is nothing. And so while there's some parts of this new tax law that are helpful, for example, they lowered the rates, losing that deduction could be not good for a lot of people. So they're going to be in for a real shock. That's all I can tell you.
Well, that really would put a squeeze on their building any type of sustainable wealth for them if they're going to have to just turn around and lose that deduction and now pay it, not get any reprieve from the federal government once they have to pay it to their state.
Absolutely. Absolutely. I've read some articles recently where some of the states are trying to fight back on this, and I remember reading some articles where they tried to say, well, instead of calling it income taxes, or instead of calling it real estate taxes, we'll allow you to make a contribution to the state and get a deduction for a charitable contribution.
Well, that's a creative idea.
A creative idea. It has zero chance of succeeding. Let me just say that. Okay. I mean, no, good luck. That's all I can tell you.
Well, that's good to have that from the inside. Now we don't have to spend any time there. Good. Yeah.
Hold your breath on that one. And, here's the other thing, too. And again, income taxes and the economy and the deficit, sometimes this is more than just finance. This is political. And so who knows if ever another administration gets in office, maybe they'll change some of these things. Because remember, these politicians who live in these states like California, their voters are going to be really upset with them that somehow this tax law was unfriendly to them. Mm-hmm. So who knows what happens going forward? You never know. Mm-hmm. All I know is for right now, for 2018, that is the law. And on that particular point, because there's other parts of the law we'll talk about too, but on that particular point, I just don't see any way out, to be honest with you. You're just going to lose the deduction. So. Okay.
Well, thanks for sharing a preview of that with us, and I know you'll be covering more about that at the Wealth Summit. Could you talk a little bit about the tax break that small business owners are getting when they have pass-through entities? I know that's something new.
Yeah, and that's a great tax benefit for people, and it actually applies even if you're a sole proprietor, by the way. Although, as you know, having done many of your seminars before, if you're in business, you really shouldn't be in business as a sole proprietor because you do pay more money.
Yeah, are you going to talk about that at the Wealth Summit too?
I will. I will talk about how you do business and corporate structuring and what's the easiest, fastest way to save some taxes. But the new tax law in 18 does give a benefit to anybody that's in business. And the first rule of thumb, it starts out, is that if you're in business and you have a flow-through entity like a subchapter S corporation or a partnership, is that instead of paying tax on 100% of the income as you had done in the past, you're only going to have to pay tax on 80%. That's a really big item.
Yes, yeah, sure. That's huge.
That's going to be nice.
As Donald would say, it's huge. Okay.
It makes you want to start a business if you don't have one, right?
Donald Trump invitation for the day. What can I tell you?
All right.
I could have said it's bigly, but I'll just say it's huge.
I love it.
Okay.
All right. So any particular are there any variations of that rule state by state, or is that totally on the federal level?
It's a rule, but what they did is they kind of there's some income limitations depending upon what you do for a business, which really kind of bothers me a little bit. Okay. And by the way, I've already thought of ways around it, but here's what they did. They start out by saying, okay, you only have to pay tax on 80%. However, if you are in a business where the income is generated pretty much by one person or from your professional expertise, say you're a doctor or say you're a CPA, okay, they have a separate set of rules in for those professions where based on your income, okay, that 20% that we said you can take as basically as a deduction, that 20% could get phased out depending upon what your overall income is. And if you go over a certain amount of income, it gets phased out to zero. So let me just suggest that if we have, and we do have a lot of doctor clients, if you're a doctor and you're in a pretty high income tax bracket, unless you do something to change things, you're probably going to get phased out from being able to claim that deduction. And I've come up with a number of different ideas on how to get your adjusted gross income down by doing some corporate restructuring. Because again, if you can get it down to the low, and if you can get your income down low enough to the point where you can take advantage of that 20%, that would be a really big tax savings for you. It would be well worth it. And so certainly we've been working on this up until now, and now that we're past the October 15th deadline, we're really trying to work with clients to see if not only can we maybe fix something for 18, but in the worst case scenario, assuming that there's not going to be any changes to this law, at minimum maybe fix it so that they can fix it for 2019.
So I'm just sitting here thinking like one of you in the audience right now, and if you're considering how this tax law is going to affect you, I think Jack just gave you 2 super good points on why you really need to be at the Wealth Summit to understand more how this works. And if you can't get there, to at least get the recording for it, because this could save you a ton of money.
Yeah, it's big. Now, I like what Jack mentions about thinking creatively too. Jack's an outside of the box thinker on both when it comes to the ideas for getting that 20% break, and also other things. And
yes.
So I'm sure we're going to be hearing more about this 20%, some of your creative ideas at the Wealth Summit. Is that right, Jack?
I just had a conference call with one of our new doctor clients. And again, we're just kind of moving forward. And basically by doing some restructuring, I think we have not only a decent chance to get his AGI lower, but even in the worst case scenario, by maybe moving some of his income around a little bit, I think he'll be able to take advantage of this 20%. And so,
awesome.
So I think even in the worst case scenario, we can help just about anybody. How's that?
That is
good.
Exciting to hear. So I'm going to throw kind of a monkey wrench into this, because I was reading an article the other day that the governor of Jerry Brown of California has decided to say that if you are having 1099 employees work in your facility and they are performing the same type of occupational duties that you yourself do, then those people are no longer going to be able to be 1099. They're going to have to be on payroll. How is this going to affect Californians and their tax returns, Jack?
Well, first of all, let me just start out by saying, even though California has some beautiful weather, they are probably one of the most tax-unfriendly states there is in the nation. And so there's always been, even before Governor Brown, came out with this article, there's always been an issue, even with the IRS, as to whether people are considered employees or they should be considered self-employed. And there's not exactly like a bright line test. There's a lot of little factors that you look at to determine whether people really are employees. Certainly if you're in business, okay, and you had a choice, you would far rather treat people as 1099 self-employed people versus employees.
Sure.
When you have employees, it's expensive, because not only do you have to pay payroll taxes, there are unemployment taxes, there's workman's compensation issues. It's expensive to have employees. So certainly, if you gave business people a choice, they'd have no employees. And so, depending upon the business that you're in or the industry that you're in, traditionally, there's been many situations where people are treated as self-employed. I was reading an article the other day. This is going to sound crazy. What about when women go into like a hair salon to get their hair done?
That's right.
Most of those people working at hair salons are self-employed.
Yes.
Mm-hmm. And they're not employees of the salon. And I remember reading an article where they're saying, well, why shouldn't they be considered employees? So it's a huge issue. I'm quoting Donald again here. It's a huge item, and I have no idea how it's going to shake out. I could tell you the rules as I know them now, and like anything else in life, if you know the rules, it makes it a lot easier. And even if you follow the rules, it may not be foolproof. You just do the best that you can to adhere to the rules the way we understand them, and you have to hope that somehow you're not unlucky and don't get hit with an employment tax audit. But you're right. I mean, things like that in California are just going to further drive business and people out of California. And listen, I came from the city of Philadelphia, and anytime a government needs more money, the initial inclination, instead of trying to figure out a way to bring more business in to generate more income, the first thing I think of, how can we squeeze more money out of the existing people? And in the short term, it works. In the long term, it drives business away. Yeah. And that's all I can tell you.
That's a good takeaway. Does. And that's why we see such an exodus from states like Illinois and Connecticut and California and New York. It's become so unfriendly. So, well, Jack, we want to jump here to the next thing, and that is you've got a funny story that I've never heard, and I know you are going to share it with our listeners here because you have some of the funniest stories about the IRS. And
can I tell you this one? Now, this is after I went into practice, and I had totally forgotten about this one. This is a totally true story. I give you my word, I couldn't make it up. We had a client, and no longer our client, by the way, but we had a client who was a very nervous Nelly type of person and always worried about everything. And I don't know, she must have gotten a notice from the IRS that she owed money. And she was really upset and distraught. And she calls the IRS on the phone. And somehow they must have thought that she was thinking about committing suicide over this. So they dial 911. I'm on the phone with the client. The police and EMTs are knocking on her door. Well, don't answer. She's on the phone with me. They break down her door. They think she's going to kill herself. I'm like, gotta be kidding me. No, she really wasn't going to kill herself, but they didn't know that. She must have been really upset talking to them, and they thought this woman's going to kill herself, so they dial 911 for her. So they break down her door. True story. Couldn't make it up.
Wow. That's amazing.
Well, I hope that none of you are ever in that position where the IRS is on the phone with you. But if you are,
the most important thing to remember about this, fella, is never call the IRS on your own. It's a really, really bad idea. And never consider suicide owing the IRS. That's not worth it, okay? Nobody goes to jail for owing the IRS money. So please, don't take it too seriously, okay?
All right, that's good to know. So I hope you bring a good story to the Wealth Summit, too, for everyone there, Jack. We'll be looking forward to that as well.
Okay, I'll try and
we've heard a number of stories over the years from Jack, and sometimes it's about you saving people a lot of money, and sometimes different things happen. It's always a lot of fun. So thank you for joining us for the podcast today, Jack, and we're looking forward to you joining us for the Wealth Summit. For those of you listening, to contact Jack's office, you can contact him at 702-255-2330. And we were talking just the other day, Jack, I know you do a lot of tax reviews for people. You look at their previous year's tax returns, and then sometimes you end up doing their tax returns for them. You have really low rates compared to a lot of CPAs.
I like to think we're pretty fair, and we're certainly cheaper than California CPAs. But the thing that I offer to any of your clients or any of the listeners, and we obviously, you and I, we work together a long time. We totally support what each of us are doing. But the truth is, for any of your listeners, any of your clients, we don't charge anything to take a look at tax returns. If you have questions, if you're stuck on something, or you think that maybe your current preparer is not doing something right, you're welcome to give me a call. I don't charge anything. I don't bite. I may make you laugh a little bit. But the truth is that if any of the listeners need help, I am there to help. And while I would like to have everybody as my client, I realize that's not always possible. But that doesn't mean we still won't help you.
Okay, wonderful. Yeah, really appreciate that, Jack. For those of you listening, you can contact Jack's office, 702-255-2330. Tell him you listen to this podcast with Life Benefits, and they'll be able to help you from there.
Well, you are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. And we will be back here next week after the Wealth Summit. Until then, have a great day.